Invest Africa, proudly brought to you by KPMG.
Hello and welcome to this week's edition of Invest Africa. I'm Nozipho, Mbanjwa. Now, merger and acquisition activity in Sub-Saharan Africa is on the rise. According to Thomson Reuters, the value of transactions hit $23.4 billion last year. CNBC Africa's Philani Nyalunga goes in search of the next big deal.
M&A activity on the African continent more than doubled last year. According to the African Development Bank, in the first 3 quarters of 2013, 115 deals were done with a value of $26 billion.
The last few years, if you said it's been quite flat with deal value. But I think more positively, the sign at the moment from 2013 is each quarter has shown an increase. So that momentum to start increasing that deal activity is starting to show.
South African-based firms are using M&A as one of the channels to expand their African footprint. The continent's largest packaging company, Nampeg, recently bought Nigerian can maker Alukin Packaging for $301 million. The company's CEO, Andrew Marshall, said the acquisition is part of the group's strategy to grow revenue in Africa by 35% by 2015.
We're expanding all over Africa. So, for example, in Angola, we've just announced $100 million, about R1 billion, for a second beverage can line because our first line has run out of capacity and it's only been going 2 years. So to give you an idea, we're producing about 750 million cans a year in Nigeria, in Angola now, and we've run out of capacity from literally nothing 2 years ago. So I could give you examples all over the continent where we're adding capacity or spending capex, but Nigeria is the largest. But we're spending throughout the continent on growing existing facilities and then obviously acquisitions as well.
The sector generating the most interest in Africa is energy, mining and utilities. According to the African Development Bank, the largest M&A deal recorded was the acquisition of mining and related exploration interests in the Democratic Republic of Congo worth $1.25 billion.
Merger market intelligence shows there's still a really strong pipeline of telecommunications deals that will follow into 2014. The mobile telecommunications market still has to undergo a lot of development, but there's a lot of potential there in Africa at the moment.
Over the past decade, Africa has been among the fastest growing regions in the world, with the trend likely to continue. The International Monetary Fund forecast African GDP growth at 6% in 2014, with investors looking for alternative markets to invest and the rise of Asian economies. There is new money available for potential African investment. And with the Deal Drivers Africa report showing M&A deals to the value of $276 billion since 2006, one can only expect this trend to continue. Philani Nyalunga, CNBC Africa, Johannesburg.
Joining me now on the desk to discuss merger and acquisition activity in Africa is Pieter Steyn, Director and Chairman of LEX Africa at Werksmans Attorneys. And in our Lagos studio, we're joined by Dapo Okubadejo, Africa Head of Transaction Advisory and M&A at KPMG, and Mayowa Amoo, Head of Mergers and Acquisitions at UBA Capital. Gentlemen, thank you so much for joining me at the desk. Dapo, perhaps let me come to you with the first question. We've heard Philani indicating there that M&A activity is certainly on the rise. What's driving the interest in African markets?
All right, thank you very much for that question. I think that if I put it broadly, there are 2 major factors driving mergers and acquisitions in Africa. I think the first one, I call it the external factors. Then the second one is the internal factors. The external factors actually comprise the significant increase in or stabilization in commodity prices. And secondly, the significant demand that we're experiencing right now from Asia-Pacific countries like China and India, with strong appetite to have a stronghold in natural resources in Africa. So those are external factors that are driving M&A activities in Africa. The second broad category is, are the internal factors. By that I mean all the factors that are currently taking place in Sub-Saharan Africa, ranging from the significant amount of GDP growth that we have experienced in the last few years, and also the fact that when you look at that particular growth and the 6% forecast by IMF for 2014, that significantly compares much more than favorably to the growth in the rest of the world. at just about 2.2%. So in addition to that, and what is driving that growth, essentially the big consumer population in Africa, the rising middle class population, and increasing disposable income as well, is actually one of the things driving the growth. The second thing, from my perspective, is also the improved regulatory reforms and environment that most countries in Africa have actually embarked upon in recent times. We've seen significant reforms in oil and gas. We've seen reforms in financial services. We've also seen in telecommunications, media, and technology as well. So those reforms are, also encouraging a significant amount of investments. And of course, when you also think about all of that, I think those are the key drivers of M&A activities in Africa in general.
Dapo, I want to throw some of your comments back to you, Peter, here at the desk with me. I mean, let's look at the global environment that Dapo speaks about. We're seeing a rebounding of global economies now. What does this mean for merger and acquisition activity on the continent?
I think the growth projections for Africa are still scheduled to increase. They average of 6% growth in Sub-Saharan Africa. So I think that's one of the fundamental drivers. I think the fact that the global economy may be on the mend will hopefully loosen up, bring more investors searching growth and looking at Africa as an investment opportunity.
Mayowa, let me come to you with this question. Of course, both Peter and Dapo have spoken about the focus on commodities and particularly sectors such as energy, mining and utility. Would you say this is a reflection of diversification strategies perhaps not being fruitful, that most of the M&A activity is still just within these sectors?
The story for Africa is still largely natural resources driven. However, that's not the only sector that is active. We have the consumer sector, like Dapo rightly mentioned. In there, you can talk about food and beverages and health and personal care. You also have telecommunications. Many of the telecommunications companies are increasingly offloading their tower assets with a view to freeing up cash to invest in other aspects of their businesses. What we also find is that logistics distribution is another sector that is attracting a lot of interest from international investors. And you can tie that into the consumer business as well, because you need distribution to be able to push your goods through the market.
Dapo, what does the landscape look like in terms of volumes and the price tags that we're seeing of the deals on the continent?
When you talk about the volume has been on the increase. And of course, when you look at 2013 over 2012, there's been an increase in the number of transactions that we have seen in that space. Now, what is driving all of these transactions? First of all, you look at almost 53% of M&A activities actually in energy, natural resources, and mining and utilities, essentially. And what is driving all of that is the reforms that I talked about. The utility sector, the power sector in Nigeria, the increased regulatory oversight and capital requirements for banks as well, also driving activities in financial services. And then, with the issues about focus on the core operations of telecoms operators, which also forcing them to diversify and sell off their towers, so that they can release cash for their core operations.
Dapo, let me jump in there, and I want to change tracks and perhaps look at the South African case for merger and acquisition activity. If we look at South Africa growing sluggishly compared to the rest of the continent, labor unrest that we're seeing, and to some extent we're also seeing a very volatile currency. If you compare it to other markets on the continent as well. Where does this leave us in terms of an outlook for M&A activity? Are we going to be losing deals to the rest of the continent?
Well, I think just by way of background, I think what's an important trend is that about 50% of the merger activity in Africa is by African companies, driven by companies in South Africa, Kenya, Nigeria, Ghana to a degree, which is interesting because of the low levels of intra-African trade, but you see increased African merger activity. With regard to South Africa, I think we do have some issues. And the growth rate is lower than other sub-Saharan African countries. But I think that being said, we are still attracting foreign direct investment and certainly interest from foreign investors in M&A activity. I think the growth sectors, however, are outside South Africa. The big deals last year certainly were not in South Africa, they were in other countries in Africa.
Mayowa, I want to pick up on a point that Pieter makes when we look at South African companies going into the rest of the continent. Let's look at the ShopRite example with a very, very big footprint here in South Africa, over 700 stores. And maybe, Pieter, you can pick up on this before we cross over to Mayowa. And when they come to Nigeria, we see a significantly smaller presence. What are the key challenges that companies undertaking M&A activity on the continent are having to deal with?
Well, I think those are the internal factors which were mentioned earlier. I think if you're operating away from your home turf, you want to know what the rules are. I think investors and potential acquirers want certainty as to the rules. They want to understand the tax regime. They want to understand exchange controls. They want to understand the regulatory environment. So I think that's absolutely key. Other issues, basic issues is due diligence, the reliability of data, the availability of data. Having local partners, I think, is absolutely key in many countries. So I think there are opportunities, but the important thing is to understand and manage the risks and take the rewards.
Of course, Mayowa, let's look at some of the hotspots, if we may call them that. To a large extent, Nigeria consistently comes up as one of those markets that after South Africa, investors should be looking at. Let's talk about the challenges that the Nigerian business environment could potentially throw up for M&A activity, and if there are any means to redress that right now.
Well, the one that readily comes to mind, I'm sure you would agree, is we are rapidly approaching the election year, and what you normally find is that investors sort of adopt a wait-and-see approach, although it's a bit early in the day. So that's one factor to bear in mind. On prior transactions, what you see is things slow down, and then once the elections go through and the new president is elected, then things pick up again. But that's at the macro level. At the micro level, you still have issues around agreeing valuation between the buyer and seller, especially where the companies are privately held. If you also consider that there is a lot of attention coming into Nigeria, what you find is that asset valuations are also rapidly increasing. And private equity firms are probably thinking this might be a good time to exit so that they can take their funds possibly to go reinvest in other emerging markets as well. But also another thing that we find in this market is despite the attractiveness, the availability of quality targets is something that investors find hard to deal with, especially in the consumer goods space. So those are the factors I think militate against the M&A development in Nigeria.
Dapo, I'd like you to perhaps extend on some of the points that Mayowa has made, and in particular, how important is having a developed market and a developed economy to facilitate M&A activity?
Yeah, it's actually very, very important. So I guess the real issue with respect to the challenges of doing deals, in addition to the point about valuation, you find out also that most of the very, very big companies and well-run and well-structured organizations have already done some form of deals or the other. So the remaining targets you have in the market right now is either the prices are too high, or you would have to adopt a buy and build approach, in which case you try and roll up those companies that would occupy the value chain, and so that you can have a strategic interest. It's no longer going to be very, very easy. And then, of course, with most of these companies, they are historically family-owned businesses. So what you have is that they're not used to the level of governance and institutionalization or even financial reporting that a typical international companies or strategic investor is used to. So there's a lot of preparation that needs to be done. There's a lot of cleanup that needs to be done. And in fact, also, the documentation of those transactions is actually also very, very key. So using local advisors, with very deep local expertise and experience that knows where the dead are buried, is very crucial in structuring some of these transactions. And that's very typical of most emerging market M&A deals. You've got to use local advisors, with deep relationships and deep understanding of the local markets and the regulatory framework for most of these deals.
Your choice of language, Dapo, I think has left us shuddering a little bit here at the desk. But Peter, we have less than 30 seconds to go. Very quickly, some of the reflections that Dapo has made. Are you finding that in the work that LEX does, that clients to a large extent are faced with regulatory challenges, or are we finding that we're actually turning the corner on that front?
Well, very briefly, I think there are new regulations coming in. For example, the COMESA Competition Commission is a brand new regulatory regime which has an effect on merger activity, particularly the closing of deals. But I think, generally speaking, I think the importance of what Dapo said is that you need good, solid local advisors and the local industry to support investors and support M&A activity. I think that's absolutely key. And the government, I think, has to come to a large way to make the environment more attractive, although there is still some work to be done.
Come back to Invest Africa. Remember that we do value your suggestions and your feedback, so please send us an email. That's to investafrica@abn360.com, or interact with us on Twitter through @CNBC Africa or @Nozipho Mbanjwa, of course using the hashtag InvestAfrica. Still with me, my guest, Pieter Steyn, Director and Chairman of LEX Africa at Werksmans Attorneys. And in our Lagos studio, we're still joined by Dapo Okubadejo, Africa Head of Transaction Advisory and M&A at KPMG, and Mayowa Amoo, Head of Mergers and Acquisitions at UBA Capital. Gentlemen, welcome back. Now, Peter, during the break, we had a very short tete-a-tete about NAMPAC making its way into Nigeria. Let's pick up on that, and particularly let's talk about what's NAMPAC doing differently that we would ideally like to see companies doing in M&A activity.
I think African countries generally want foreign direct investment. They don't want people to buy stocks on the stock exchange. So the NAMPAC type investment, buying a factory, investing in a factory, developing Nigerian manufacturing capacity, and no doubt driven by sound commercial motives, because Nigeria is a booming market. It's interesting that there's the new, BRICS was the hot term a few years ago, or even last year. Now they've got a new one, MINTS, which is Mexico, Indonesia, Nigeria.
And another one called the
Turkey.
Exposed 8. I think that came up last week.
It seems to be that people like these acronyms.
Right.
But I think Nigeria is a key market, and I think South African businesses have identified Nigeria as a key market to invest in. I mean, MTN, NAMPAC, ShopRite, and others.
Mayowa, let's talk a little bit about this NAMPAC deal, South Africa coming into Nigeria and actually going with a manufacturing muscle as against just buying into the stock market. Are we finding that this is on the back of policy or some pressure from government to ensure that there is a development of local industry and employment of local people on the back of M&A activity?
Yes, I mean, that's absolutely correct. What you find across many sectors, not just in manufacturing of cans, is there's a lot of backward integration. There is active promotion of employment, in the country, preservation of foreign exchange to stabilize the naira even further, so that the environment is even a lot more predictable. All of these factors are conducive to international investors coming in here to take long-term views of the economy, compared to portfolio investors on the capital markets that can go in and come in and go out very, very quickly, like what you had during the financial crisis.
I mean, very earlier on, Dapo, I think Mayowa made the comment that there are elections coming up in Nigeria, and of course the same is for South Africa coming up a little bit later this year. When we look at the election calendar, is this something of concern to investors, especially when you look at markets like South Africa and Nigeria that are fairly developed? How important is the election activities and the political activities in particular for M&A activity?
My view, based on historical trends, is that normally and naturally during election periods, you see a lot of agitation and anxiety because of the politicking that is going on. But, in the last few decades, for instance, you see that we've had successful political transitions in Africa, over 30 of them, so as democracy becomes entrenched in most of Sub-Saharan African countries, we see less and less concern about it. I mean, it is a concern, but given the fact that we've overcome this issue several times, there's been a political transition several times, even in Kenya. So for those investors that have long-term perspective and they understand the terrain very well, there are a lot of the sectors that are not necessarily impacted by this. So, and we don't have any concern at all as to the fact that there will be a successful election, and the impact will be kind of very soft at this stage. But immediately the election is concluded, we see a renewed interest. You can't ignore a country like Nigeria, a country of almost about 170 million people. I mean, a huge market, middle class population. You can't ignore it. So election or no election, I think the economy will be growing significantly, and very shrewd and highly long-term committed investors will know that we will do this transition successfully too.
Peter, let's look at government from a different prism. I mean, if we look at certain mechanisms through which the government interacts with the financial markets and the economy, and we look at pension funds and we look at sovereign wealth funds, to what extent are these entrenched in M&A activity and driving M&A activity on the continent?
I think they're not so much driving, they're not the acquirers. I mean, pension funds, state pension funds, sovereign wealth funds, but certainly they are important investors. And state-owned enterprises is another very important factor in most African countries, including South Africa. Which, for example, in South Africa, the state-owned enterprises are driving the infrastructure drive. Because development in Africa, and particularly the harmonization of the trade blocks, requires infrastructure. You need one-stop border posts, you need ports, roads that work, railways. So I think government definitely has a role to play. I think the challenge is where you do draw the line of regulation. And that has an impact on M&A activity.
Dapo, coming back to you, I want to maybe move on from the point of government and look at exit strategies and how important investors would view an exit strategy out of an African market before they commit to any M&A deal.
Yeah, I mean, with respect to exit strategy, it depends on the investors you're talking about. If you're looking at strategic investors, they are mostly in Africa for the long term. But if you're looking at the financial investors like the private equity investors, then of course exit strategy is very, very critical. And there are many exit options that are available in Africa. The typical one, of course, is the IPO. We know, of course, that most capital markets in Africa are not very liquid, or the depth or the number of products and the sophistication is not as much as you have it in South Africa. But it's deepening, and it's also growing as well. There's increased confidence and trust in the capital market. So the IPO is there. Then the secondary exit, whereby for the private equity, the smaller private equity houses are able to exit to bigger private equity houses, is obviously also still an option as well. But by far the most significant that we have seen is the entry of the strategic investors. As growth slows in most OECD countries, Africa is the last frontier, and a lot of companies also want to diversify their portfolio, and growth is a major issue. Companies have to grow, and in most cases, inorganic growth, has proven to be a much viable proposition, particularly if you have opportunities in a place like Africa with over 1 billion people in 50 countries, well-diversified economies at different stages. So exit is one that, and we've seen a lot of the private equity houses that have successfully exited many transactions, from Actis to African Capital Alliance to Ethos in South Africa, so there's been quite a lot of exits, actually.
Mayowa,
I mean, there is a challenge there. I'm not saying it's easy, but it's obviously getting much better.
It's getting much better. Mayowa, let's talk a little bit about the Asian factor, which I think we haven't dedicated much time to, and look at the rising interest of Chinese investors into Africa. A few days ago, we get this data that the Chinese economy is no longer growing as fast as we had expected it to. Your outlook in terms of Asian participation and particularly Chinese participation in M&A activity?
Granted, the Chinese economy is slowing down, and I think it's expected after several decades of rapid growth and urbanization. Notwithstanding, it's on record that in 2013, out of the top 10 transactions, 3 of those were done by Chinese companies, and these are multi-billion-dollar transactions. of course, in energy and natural resources, mining and utilities. I think in terms of going forward, the strategy is changing somewhat. Many Chinese companies are looking to acquire strategic stakes in many countries in Africa in sectors other than just energy and natural resources. So including consumer goods, logistics and distribution. As we all know, the Chinese have a way of just being so very efficient. And Africa has a lot of inefficiencies, and when you hear inefficiencies, that means opportunity. So in my view, we do not expect to see a total slowdown of Chinese or Asian investments in Nigeria or in Africa. Rather, they will continue to be a major player in this part of the world. There is also the political angle, because the world is or has been largely dominated by Europe and America. China has now come in as a counterbalance, if you like, and we do not see them slowing down anytime soon.
Mayowa, I'm going to close it right there because we've just run out of time, and unfortunately I didn't manage to get your final comments, but I did see you nodding vigorously, so I would take it that you do agree with a lot of what Mayowa said in his closing statement. We have come to the end of this week's episode of Invest Africa. Thanks again to all my guests: Pieter Steyn, Director and Chairman of LEX Africa at Werksmans Attorneys; Dapo Okubadejo, Africa Head of Transaction Advisory and M&A at KPMG; and Mayowa Amoo, Head of Mergers and Acquisitions at UBA Capital. Bruce Whitfield is up next as he unpacks the latest news from South Africa's economy on Tonight with Bruce. Until next time, it's goodbye and thank you for joining us.